7 possible signs a recession is coming. What is recession? Recession is a slowdown or a massive contraction in economic activities. A significant fall in spending generally leads to a recession. Such a slowdown in economic activities may last for some quarters, thereby completely hampering the growth of an economy. In such a situation, economic indicators such as GDP, high interest rates, stock market crash, etc. This creates a mess in the entire economy. To tackle the menace, economies generally react by loosening their monetary policies by infusing more money into the system. Example, by increasing the money supply. This is done by reducing the interest rates. Increased spending by the government and decreased taxation are also considered good answers for this problem. The recession which hit the globe in 2008 is the most recent example of a recession. If you hope to predict the economic future, good luck. Even experts routinely get it wrong. It's time to familiarize yourself with the clearest warning signs of a looming recession. Here are 7. 1. Rising interest rates. You might already know how interest rates affect your finances. But you might be wondering how rising interest rates can be a recession warning sign, yet also indicate a growing economy. To understand this concept, you first have to know what the natural interest rate is. There is an idea in economics called the natural interest rate. This is the underlying value interest rates would naturally take given the fundamentals of the economy. The Fed's job is to try and align itself with this unobservable rate. And that's the tricky part that can cause trouble for the economy. What this means is that for interest rates to be raised too high and cause a recession, they have to be raised above the natural interest rate. Past recessions and interest rates. While raising interest rates above the natural rate can spur a recession, that doesn't necessarily mean higher interest rates can be considered a sign that a recession is on the way. That's because the Fed always raises interest rates during periods of economic expansion, and the boom and bust cycle of the economy means there are always periods of economic expansion preceding a recession. So, while higher interest rates always come before recessions, they also come before continued prosperity, making them a pretty unreliable sign to count on. For that matter, it's also important to note that leaving interest rates below their natural level can be even more disastrous. When it's too easy to get loans, it can lead to too much speculation chasing fast profits, causing the economy to grow too fast and then crash dramatically. 2. A drop in housing construction and sales. Two of the clearest indicators of a pending recession are sharp drops in both new housing construction and home sales. The housing market is one of the major drivers of the U.S. economy. If you add up all of the money Americans spend on building houses, buying houses, renovating and renting houses, it adds up to 1/6 of GDP. That's why two of the clearest indicators of a pending recession are sharp drops in both new housing construction and home sales. Economists pay close attention to the number of housing starts or new housing construction projects breaking ground each month. An increase in housing starts means that builders are confident that the economy will continue to perform well over the next 6 months and that consumers will have the available cash to buy new homes. Other housing indicators act as a barometer of consumer confidence, like the monthly reports of pending home sales and existing home sales. When consumers feel good about their future job security and earning potential, they are more likely to make a big financial plunge like buying a new home. When the worry about layoffs and stock market declines, housing sales numbers go down. Looking back at housing data since 1960, housing starts have decreased 25% on average before each recession. 3. Reduction in GDP. A recession basically means that the economy isn't growing, and the barometer of economic growth is a measure called Gross Domestic Product, GDP. This means it's worth monitoring this quarterly data because any signs of a faltering economy are bound to show up here. But it's also worth comparing gross domestic product with economists' longer-run expectations. This can help you know whether general fluctuations in GDP are any cause for concern, and it can also help you determine what the output gap is. An output gap shows the difference between the actual output for the U.S. economy and what economists view as its maximum potential, and it can be either positive or negative. Real GDP, which shows growth adjusted for inflation, exceeded its potential in 2018 for the first time since 2007, according to a report from the Congressional Budget Office. When actual GDP is rising above its potential, we've historically seen these trends where the actual GDP rises above potential and it hits sort of a peak, rolls back over, and falls below potential. These are the cycles that ebb and flow over time. The U.S. economy grew by 3.1% in the first quarter of 2019 and expanded by 2.1% in the second quarter of 2019, according to the Department of Commerce. The Federal Reserve's long-run growth potential for the U.S. economy is at 1.9%, according to its summary of economic projections updated in June. 4. Sustained stock market losses. The stock market is a reliable indicator of overall economic health. A sustained drop in equity values is a leading indicator of the lower profits expected to be earned by corporations, at least lower profits than the stock market had previously expected. If businesses lower their expectations for the future, that means they'll be taking out fewer loans and hiring fewer people, which impacts the broader economy. And when stock prices across the board go down significantly, it starts to eat away at the long-term savings of average consumers, causing spending to drop. When CNBC analyzed post-war stock market performance for hints of upcoming recessions, it found a strong correlation. The longer a bear market lasts, defined as a drop of 20% or more in stock prices, the greater the odds of it signaling a recession. Bear markets that cause recessions lasted 508 days on average. If you found value on this video, please like and subscribe for more videos like this. 5. Yield curve. One of the most closely watched indicators of an impending recession is the yield curve. A yield is simply the interest rate on a bond or treasury. These treasuries have differing lengths of duration, known as their maturity. Some bonds last 1 month, some last 30 years. The curve, therefore, compares how those interest rates change over time. Typically, the interest rate, how the U.S. government issuing these securities compensates investors for risks, is higher on a bond with a longer maturity. When the yield curve inverts, however, the curve becomes downward sloping. This inversion means investors are demanding a higher yield for treasuries of shorter durations. In this case, they think it's riskier to hold their bond over the shorter term. Traders, economists, and strategists alike watch this curve because it has a particular track record for preceding downturns. In a world where economic indicators come with a lag, most data is naturally backward-looking. Inversions of the yield curve, however, have preceded recessions for the past 50 years. There are two main yield curves that investors follow for their predictive power: the 10-year and 3-month Treasury rate, and the 2-year and 10-year Treasury yield. 6. Taxes bring in less revenue. During an economic downturn, states typically see a decline in revenue, according to the Brookings Institute. State sales tax can be especially discerning of consumer confidence. A common reason sales tax revenue can come up short before or during a recession is because Americans aren't buying enough goods and services that the government can tax. And when consumer spending plunges, recessions usually follow. Past recessions and taxes. It's harder to draw clear one-for-one comparisons because of many other factors that also affect levels of tax revenues. Public policy, population growth, changes in tax rates. However, there are noticeable slowdowns in growth during the recessions of the early 1990s and immediately after the dot-com crash. Also, total sales tax revenues declined in 2009 while the economy was in free fall after the collapse of the housing market. 7. Consumers start to lose confidence. When consumers hold back on their spending, that's a sign of a recession. The economy is driven by consumers. When they're feeling good about the economy, they spend more. When their confidence droops, they become more tight-fisted. If consumer spending slows, that normally indicates a recession has arrived. Surveys that measure how consumers are feeling are watched closely by economists. The Conference Board surveys consumers to produce its monthly Consumer Confidence Index. Morgan Stanley economists have found that a 15% drop in the index from one year to the next indicates a recession, according to the New York Times. If you want more videos like this, please subscribe and write your questions on comment section. Thank you for watching.